Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to, once again, John Teixeira. We are back this week with Trever Kerr with Gateway Mortgage to discuss our fantasy football draft. No, just kidding. To discuss a mortgage update. If you guys have any questions about this, want to give us a call, 817-818-9039. Shoot us an email at showmethemoney at wearetpm.com.
I messed that up.
Fantasy football draft, right? That's what we're here to discuss, right? No, I'm just kidding.
My son already announced that I was the winner after looking at my team. So.
Oh, yeah? Yeah, so there's nothing to discuss anymore. So, yeah, we won't.
Should we declare you the winner?
Yeah, put my name on the trophy and let's go.
There we go.
It's already on there twice. We're not putting it on there without making you earn it, okay?
Jamar Chase will get it done for me. All right. So in the world of real estate and mortgages, what are we looking at, Trevor, since we had you on last? Nothing's changed out there, right?
No, nothing's changed dramatically on there. I mean, just looking at over the last, 90 days and stuff, rates have come down about an average of about 0.25%, down to 6.58 as a, blended rate between all the stuff, which we were sitting at about 6.83 about 90 days ago. So it has improved slightly, okay? Looking at last time the Fed made a rate cut was December of 2024. And we are expecting 2 rate cuts this year now is what they're projecting anyway. One, we'll see about a 25 basis cut here in the next couple weeks. And then we're expecting another one sometime in December. So,
yeah, I think a quarter is pretty much baked into September, no matter what.
Yeah.
It sounds like we might get a half, but nobody holds their breath for that with these guys right now. So
yeah. No, they're projecting a 25 basis point cut and then another 25. So, I mean, we're going to most likely be getting down to right around 6, 6 and 8 somewhere, by the end of this year.
I think historically, I think what's happening right now, it seems like, is what historically happens, and that is that the mortgage rates try to anticipate that, right? They try to use their crystal ball.
Yep, they do.
and then they try to anticipate it, and if they get it wrong, then they adjust it back. But so that's kind of. Do you think that's kind of why we're seing lower rates? Is in anticipation of that?
Anticipation of that Fed cut.
Well, and bond yields, right? The whole bond market's not, or actually is helping the mortgage rates. So I think, what do you think psychologically? You can talk about basic basis points all day long, but once we get in the fives, how far are we from the fives, Trevor?
That's a huge deal. I don't think we're going to see the fives until sometime, mid next year, to be honest with you.
There you go.
But psychologically, yes, for some reason that 5.875 just seems so much better than a 6.
Yeah, 5.99 will start making things move around.
I've read some opinions that we're not going to see the 5s anytime soon. So like even next year, like they think, I've read some opinions that they think that we'll get down to, like 6.2, 6.3 might be the lowest we see next year.
There have been projections. Some of them are projecting high 5s. Some of them are projecting that, we're going to bottom out at low 6s. So, who knows? It's like flipping a coin.
And let's remind everybody that's still way below the historical average, right?
Yep. I think Q4 will show us a lot, because the jobs data is what's now. Is their reasoning for, maybe being more aggressive with or I guess you would call it.
They have a huge incentive on trying to get those rates down with, our country having to refinance our debt. So that it behooves them to get it down.
Well,
especially when no one else is buying the debt. Yeah.
I read, I don't have any idea. Sometimes I don't know if this stuff is true, but I read that we're $500 billion into this tariff thing, right? I assume that goes toward our debt. I hope. I don't know who's taking care of the purse strings, but
where that money's going?
Yeah, I don't know.
It goes to the unlimited credit card.
Yeah.
But they say we're quickly coming upon that trillion mark. We've passed the $500 billion and we're like quickly coming on that trillion mark. If we've actually done it that quickly, I think our debt's at like 3.5 or something like that, if I remember right. It's at historical levels. Man, if we could start knocking that out before we lose the guy that's making it all happen, then that'd be nice to start fresh, wouldn't it? Start clean again and be in a different
35 trillion
different position
in 3 years.
Not 35 trillion, 3.5 trillion.
What's 3.5 trillion? The debt?
Yeah.
No, it's 35 trillion.
I don't think so, but okay. All right.
Maybe.
It definitely is, but yeah.
Let's chat GPT that, see what it says. On the podcast live, what is
Isn't there like an online tracker for the national debt, like nationaldebt.com?
I'd be scared if you're right.
It's going to be more because that was the whole.
I'll be scared if you're right.
That was the whole thing. They just got voted in as increasing it. It's probably up to 36 after that bill passed.
37 trillion.
Yeah, see, they increased it 2 months ago and already added 2 trillion to it. So
Trump needs to work harder. Forget everything I said. He needs to work harder. More trillions.
More trillions.
Holy mackerel.
You know, the $4 trillion that they bring in every year, even if you fit every dime towards it. So, but we're not going to talk about that math equation. So.
All right, we're here to talk about mortgage rates.
Yeah.
So Trevor, what does this mean for investors? Well, no, before we get into that, what are you seeing right now? You said that it come down a little bit just in the recent past. Are you seeing any increased activity? Are you seeing anything from that?
Not right now. You know, school gets back in and stuff.
Yeah. It's a tough
slows down all the time, you know, so I expect things to start picking up a little bit.
But you would expect mortgage applications at least to get started, right? Even if people aren't out looking, people would be calling you about refinances and mortgage, you know, pre-quals and stuff like that still, right?
No, I mean, applications are picking up a little bit and stuff. Contracts aren't picking up yet, but I expect that to start happening over the next, month.
Well, here's an interesting question, because over the last 2 years, I mean, you know this, everyone's like, oh, we'll refinance when rates go down, right? And the next year has become 3 years from now, or 3 years from then. How many of those people are calling you back to refinance in these low sixes?
No, they're still waiting.
Still waiting in the low sixes yet.
And,
well, but we're just getting to. You're right though, Kyle. We're just starting to get to a period, Trevor, that I think where people could start listening, or it could start making financial sense to do it.
It's getting real close to that point, because a lot of people over the last 2 years and stuff had a rate in the sevens, low sevens and stuff. So I always recommend at least saving 3/4 of a point, before you start looking at doing it. Some people that are a little bit more greedy and just want to do business will recommend clients do it at a 0.5 point. I don't think so. So,
do you have any calculation for investors that are looking at doing stuff like that based on, this is probably the opposite of a sales pitch for you, I guess, but how much interest they've paid and their principal when they're looking at refinancing, like the effective interest rate on that, or the amount of interest you pay per year technically changes if you're like 7,
rolling
8, 9
that
years
into your calculation of whether you should do it or not.
Yeah, kind of. I mean, investors do it,
right? Like, I've paid 9 years of interest. Should I figure out whether it's fiscally responsible for me to refinance and kind of roll that into that calculation that he's figuring out?
Yeah,
is that what you're asking?
Yeah, it's a conversation I had at a conference last week, but it was like. But you have different lives of loans, so how long you're going to keep it is really
I mean, that's the one thing that you can't just tell someone, because obviously it depends on how long they plan on holding that, loan and stuff before selling or doing something. But my kind of rule of thumb is, we want to, for the closing costs and stuff they're coming out of pocket or rolling back in their loan, I always look at, you got to recoup that money within 1.5 years, time frame is kind of my general rule of thumb.
Let me reframe Kyle's question a little differently. See if you have an opinion about this. I don't know if I'm sure you've given this some thought, because it's what you do for a living. If I have a 30-year note and I'm paying my payment every single month, I'm paying my front-loaded interest, right?
Mm-hmm.
At what point into that loan does it not make sense to refinance it, even if I'm making my monthly cash flow better?
So, yes. So looking at that, I mean, if you're talking about that you have a 30-year fixed rate loan and stuff, after you're 15 years into it, it really doesn't make sense.
So even if you're decreasing your monthly payment by $200-$300, people should still recognize, right, that you have just paid, I don't know, $250,000 in interest over the past 15 years, and starting that over again and throwing that away, even though it'll be lower now because your principal also went down some, it doesn't make sense because now on the back half of it,
you're starting back
you're
over
more
on
principal
where
than
it's all
interest.
front loaded again.
Yeah. And you're better off taking the hit on monthly cash flow than paying, hundreds of thousands of dollars more in interest again.
Yeah. Not, I mean, and that's if you're comparing it and going back to a 30-year loan again.
Yeah.
At that point in time.
You do that calculation differently for a 20 or a 15, right?
Exactly.
Probably halfway is what you would say, right?
Yeah.
Right? Halfway through the term
pretty much
of the loan. That was kind of a different way of asking what you were asking, Kyle. But...
Yeah, and we've brought this up before that you can change those numbers by, doing a 15-year note in that example. Could be beneficial to you.
Yeah.
You're still going to, assuming you're going to still see this the next 15 years through.
Yeah.
Go ahead.
I was going to say, so Trevor, hopefully our audience is investors, most of our audience, right? So what does this look like for an investor? You just gave us 6.5. I would imagine that's if I'm buying a house for my primary residence, that's probably what I'm going to pay is somewhere around that 6.5. What are investors looking at right now?
Investors are looking at somewhere in the low sevens right now.
Okay.
Generally speaking, you're looking at about 3/4 of a point higher than normal, primary residence stuff. So, but the other good thing is, right now in this market, homes are sitting a little bit longer and sellers are willing to pay closing costs and stuff. So, there's 2-1 buy downs, 3-2-1 buy downs and stuff that we can, get the seller to pay closing costs and look at, a 3-2-1 buy down or a 2-1 buy down, for them where they're starting, instead of at a 7.25% rate, they're starting at 5.25% the first year and 6.25%. And hopefully, and I think, over the next, year or so, year and a half, they're going to have an opportunity to refinance and stuff. So
is there prepayment penalties in those kind of loans? Okay.
No.
Well, that depends on who you do it with.
Well, yeah,
with Trevor, there's no prepayment penalties. With other people, there may be. So to reframe what you just said a little bit is basically if I were to, typically people understand buying down points, I think, right? So if you were to go to your mortgage person and he says, okay, the loan is at 7.2 right now for an investor.
Yep.
And they want to put some money down and buy that down to, I don't know, 6.5, what would that cost them?
6.5. I mean, that's going to cost them quite a bit of points.
Okay.
I mean, it's 3% or so.
3%, so $8,000 depending on the sales price, whatever it is. So
you get a 1/4 point for every discount point in most cases, right? Something like that.
So using your example of the 2-1 buy down, basically we kind of did the same thing on a temporary basis, but we took that money that it cost to do that, right?
Yep.
And we asked the seller to pay for it. Because of our current climate. So it didn't even come out of your pocket. You're now paying less interest for the first 2 years, and you didn't have to buy it down or pay out of your pocket to get that done.
That's correct.
And I mean, that would be a really good scenario for an investor. And this all gets to something I was going to bring up with you, Kyle, but I feel like you have a question for Trevor. No, you didn't? I was misreading you? Okay.
No, not to that comment.
So it seems like, Kyle, we talk about this a lot, right? And one of the things we want to get out of Trevor while we're doing this is we always talk about why should I buy right now, right? We're always looking for the reasons. Why should I buy? Because you and I think, feel like it's always a good time to buy. I know it's better times to buy, other times than there's varying degrees of that, but you should always try to acquire real estate in some way, to help build your wealth. But it seems like now, based on what Trevor just said and kind of what I'm reading, that we're at a point where the market is as much of a buyer's market as it's probably going to get, right? As far as getting prices down, like you said, Trevor, getting seller concessions.
Yep.
And rates are starting to come down. So if you were to buy as an investor between now and what would you say, Trevor? Maybe like mid next spring might be the ideal time.
Because it definitely is going to be the ideal time, because as soon as, we're talking about rates, and if rates do hit, fives, this market's going to turn around so quick and prices are going to go up.
But I don't even want to talk about fives, because that may never happen. But if it just comes down a little bit, like you said, into the low sixes, it helps those cash flow numbers people are looking for, right? Especially when they're at the lower sales prices.
Yeah, when people are looking for bottoms of markets, right? Or which is, you call it a bottom, it's the best time to buy. You look at the cycles. You look at history and the cycles, and generally in history, when you find out you're there for sure, you're too late, right? So, and we've done this a lot, know, in mortgage and in real estate. I talk to y'all about it all the time. Where when interest rates actually go down, home prices have already started increasing, right? So, it's nothing different than the stock market. When they're greedy, be fearful. When they're fearful, be greedy. Well, in real estate, a fearful market is when sellers are paying your closing costs, right? It's desperation. It's these things need to be sold. That's when you see investors going out there. And what we're seeing on our end is that's happening on the retail market. On the wholesale market, you're starting to see this fear level of like, they're giving out deals like crazy. People are desperate. They're just trying to dump things. There's a lot of investors underwater, which causes this transfer of assets. So it preempts what you guys are talking about, which is, are we at a bottom? You'll always know the bottoms are in the past, right?
You're using all kinds of big words and anticipatory factors and stuff, but all I did was go to mycrystalball.com. That's it.
My crystal ball?
Yep, that's it. And it just told me now's the time to buy, period.
Now's the time to buy.
Well, when we talk about it, it's always time to buy. So we'll buy in any market.
Well, that's true, but now's really the time to buy.
It's like over the last 20 years.
We will buy in any market. You're right. Unfortunately.
If I bought every top of Apple in the last 20 years, I'd still be looking pretty nice right now, right? So that's the example.
Point. Good point.
If I bought at the worst possible time of the year every year for the last 20 years, I'd be rich. So depending how much I bought, you got maybe more than $1. So, but let's bring this back to mortgages. So how quickly do you see those turns, Trevor? And I'm not going to ask you about COVID, because that was going from like a 6 to a 0 in a day. In the normal cycle, how quickly do you start seeing those mortgage applications and the refinance applications just really start to flood all at once?
Well, like I said,
or what's the normal pace, I would say, that you see when that happens?
Once the general public starts seeing the rates come down and stuff, it does take a little bit of time, but that they're looking at rates, and again, it's just a psychological deal. If rates hit in the fives, that's when everything's going to go. If it doesn't matter if it's 5.99, it's just psychologically in your head, there's a 5 there, and things are going to start moving. And again, this market's going to turn around and go crazy.
Well, and markets are very dependent on psychology, because 2-3 years ago when rates started going up, people are like, well, when they get back to the threes, now everyone's like,
never happening.
When they break 6, we're going to be good. So that's
well, there's also a factor here that nobody's really talking about, and that is we still have we still have a reality that at one point 80% of mortgages were under 4 or something like that, or 4.25 or something like that. Like, so those people haven't sold. They're not selling. They're not refinancing. They're not doing anything. So if they're at let's say in 2000, say 4 or 5 years ago, we had 80% of our mortgages in there. That means 80% of the inventory, or close to 80% of the inventory, still isn't going anywhere, and probably isn't for the next 10, 15, 20 years. Like who would ever do something when they've got their home leveraged that way? it just wouldn't be smart to sell or to refinance. And even the dumbest of people could recognize that. So that's going to have an impact on how, Kyle asked a great question, how quickly? Well, it might be softer. It might be a softer ramp up than it normally is because of all that inventory that's just not going to go anywhere.
Yeah.
Right.
And those numbers are are going down slowly. 80, you mentioned
80's probably
80%.
65 now or something.
70 or,
Yeah.
So, because there's
Still
always
a large
going
number.
to be some turnover, from, divorce or relocation, stuff like that. But yes, that number is extremely high of, houses that are just tied up because, like you said,
it's almost
they're
like
not gonna move.
you just take them out of the inventory, right?
Yep.
And don't even consider them. And now, so instead of, I don't know, 300 million units, now you've got 165 million units you're working with. That has a major impact.
No,
I made those numbers up, but that has a major impact on the market and how it works and how it ramps back
Definitely.
up. And how what you're talking about, Kyle, is, like how quickly do things flood again? It may not flood. It may be more closer to a trickle. Or somewhere in between.
Well, yeah, and that's why I asked what that pace would be expected to look like, because it affects, the real estate market. I mean, they play, in that scenario, they can play very strongly together, but depends on whether those applications are for refinance or if we got contracts moving, right? Which brings me back to something we talked about either the last time you were here or second to last time you were here, because this was a very market-based product that Gateway started doing. Was second mortgage.
Seconds.
Yeah.
Mm-hmm.
How has that progressed? Did a lot of people take advantage of that for the reasons John just mentioned?
Yeah, there's a ton of people that have taken advantage of that, because obviously they don't want to refinance their 3% interest rate into, now a high 6 or something. So it gives them the opportunity to access some of the equity in their home, keep their other mortgage and now have this other, standalone second mortgage, at, the rates on those right now are at 8.125 and 8.25,
Yeah.
But
well, and I think that was important for, the bigger companies, like trustworthy companies like Gateway, to start offering that, because or else we'd have even worse of a supply problem than we have now.
You got to find solutions to problems, right?
Yep.
And so innovative companies like Gateway they see a problem and they go find a solution for it, and it's really important.
Well, and they probably want to continue to make money.
If
and
you're going to find a solution
and write loans,
makes them money. Yes,
it's for the good of the people.
Good of the people.
Good of the people.
That's how you make money: is you find a problem and you find a solution, and then you make money.
Very true. Very true. So, but that's because that also helps with the math we've talked about. Because like if you're at a 2, you're at a 3, like 8.5 sounds high. Well, if you take your total debt on the house and average those two together, you can get a little bit closer to where you want to be, right? The 5.9s.
Yep.
What did those go up to as a reminder for anybody listening for LTV?
80%.
80% on personal residence,
yep.
I imagine. So are you guys doing those on investors still?
We are.
Yeah.
What's LTV? Is that like a stock ticker?
It probably is. Loan to value. Maybe we should buy that stock ticker just for all the mismentions of LTV as things go on, I don't know. Do you not know what an LTV is?
I knew what an LTV was. I was just trying to be, you're using jargon on a podcast, so I was just trying to help anybody that might be listening. I doubt anybody's listening, so it doesn't matter.
We mention LTV all the time, so, loan to value.
Still,
loan to value, So. What is LTV, Trevor? Let's let you explain it.
Loan to value. How much your house is worth right now in this market. Let's just say, for instance, 300,000, your house is worth 300,000, they will lend you up to 80% of that. So say you have $100,000 left on your mortgage on there, they'll let you go up to 240. So you have $140,000 in equity that you can access.
So I just go and look at this estimate and I'm like, it's worth 300,000.
Well,
Oh, we got to pay for an appraisal. That's
Hey,
right.
in some states, yeah, you're gonna have to pay for appraisal probably. Well, unless depending on how much you're taking out, but
We'll take the tax appraisal sometimes, depending on.
We'll do an AVM on it and stuff most likely.
Yeah.
it's another acronym. Is that another stock ticker?
Another stock ticker. Go ahead and buy that one. Automated value model.
Thank you, Trevor. I'm playing the dumb guy over here.
Does estimates an AVM? That it's Zilla's
It is
AVM,
an-
right?
is an
It is an AVM.
So,
But
And in some states,
theirs are not so good.
well,
some of the
not
time,
here in
so.
Texas, they're not. But I'll tell you, in some states, they're dead on. So they're good some places. So
what should be interesting to see is next year what these appraisal districts do, because we're seeing homes with appraisals that are 200% of value in some cases, because it's insane. So. So your taxes will go down, right? So tax appraisals will be very important next year. Protests, I should say.
Protests.
What are people asking? What are people asking about when considering buying a home, John? What do we got for Trevor? What are their questions for Trevor?
as far as investors or
Well, they're the only ones shopping right now. So yeah.
Well, yeah, well, the what we've talked about, what everybody wants to know is what's my interest rate going to be and what's my monthly net going to be, which is a jargon term for meaning my monthly expenses, right? That's what almost all of them want to know. There's cash out there. People are finding the cash to go acquire homes and put down payments down and pay closing costs, even if they're not getting seller concessions. But most investors are uber focused on their monthly cash flow. So that's mainly the main conversation I always get, no matter what the financial picture looks like at the time. But
Does it cash flow?
Does it cash flow? That's all they want to know. And you start getting into bigger
Keep telling them no.
investors, then
Keep telling them no.
I give them all the other reasons why they should buy.
How much money do you want to put down until you see some cash flow?
Tax advantages, appreciation, all that. I can find all kinds of reasons to buy besides cash flow, but that's why we were talking about. We're starting to get to that point where things are starting to at least break even, if not cash flow, as they start to get to the numbers that we're talking about.
Yeah.
I got a good one I got asked the other day. It's pretty obvious to everybody that we're at a pivot point regardless, right? Like something's got to give. Got a lot of supply, not enough demand, high interest rates. Like you won't live here for 2-3 more years in this exact dynamics, right?
No.
I'm not going to say I'm predicting where it's going to go, but it's going to go somewhere. So I got asked the question the other day: how does it not fall off the market fall off a cliff, like in 2008 come next month, right? Because school's out. And that's a very vague question about some very complicated things, but I have been asked it 3 times recently. And one, it's not going to fall off a cliff like 2008 because that had nothing to do with the real estate market. What, you look like you have something to say.
I'm just shocked that you've been asked this question 3 times. It doesn't shock me that somebody would ask this question, but you've been asked it 3 times by 3 different people. So this is actually a theme that's going around. Could you repeat the question? Make sure I understood it correctly.
Well, one was actually not by an investor. It was by someone who is in a different market the other day. But different.
Well, it doesn't matter. Nationwide, we're all dealing with pretty much the same thing.
Similar right now. So, but how does the market not fall off a cliff come next month? They were talking about when school gets out or the market generally slows down, given nothing's moving.
You mean when school goes back in?
Yeah, when school goes back in. So it's a very vague question.
Like 2008.
Like 2008. It's also not a very historically accurate question.
I don't even know if that's a worthy question to answer. Do you, Trevor?
Yeah, I don't.
I've been answering it.
Really?
One, that the market didn't crash in 2008. It crashed from 2006 to 2008. But
no, that's not true. Well, it started.
Depends what market we're talking about.
Yeah, it depends on what
complicated
market.
Answer.
The housing market literally fell off a cliff in September of 2008. I'll never forget it because I was on Trevor's front porch when it happened. And it literally happened overnight. So yeah. I'll never forget it. And And I think we drank a lot that night too, didn't we?
I'm pretty sure we
Because
did.
we were going, we were hitting it hard, and we were doing a lot of good stuff for a lot of people. And then all of a sudden, overnight, it changed.
Yep.
And we're like, oh crap, how are we going to pivot, and what's our business going to look like now? And we did.
We always find a way.
We did,
Yep.
didn't we? Fist bump right here, baby. Come on, let's go.
But the answer is that sounds like fear, so be greedy.
Yeah.
Yep.
Yeah, I like it. I like how you wrapped that up. That was great.
Yeah, that's literally the answer.
The BS
I gave.
in between didn't matter.
Yeah,
right? It just came down to that.
You
I
are
love
historically inaccurate. You're not considering the right factors, but whatever. You sound really scared, so go buy something.
There you go. I love the way you wrapped that up, Kyle.
So,
that was beautiful.
Yeah,
that was beautiful. Love it.
Well, you guys have anything more to talk about, or should we let these people go?
Anything else we need to know, Trevor? We're here for you.
No. I think that's
tell
about
everyone how they reach you and all that good stuff.
You can give me a call or shoot me a text anytime at 972-822-7408.
We can always hook you up with Trevor if you need. 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. We are ready to go buy some stuff, so we are out.
Let's go.